This week's episode of Dollars and Cents, we're going to talk a little bit about what's right with the markets and the economy. There certainly seems to be sort of a underlying pessimism lurking out there. We're going to give some reasons why maybe you shouldn't be that pessimistic after all as it relates to the markets and the economy. And then we're going to talk about this big sale that is going on with Florida prepaid college plans. If you go to the website, you see big sale going on, lowest cost in 10 years, big discounts or big reductions in the amount that you have to pay to do a Florida college prepaid plan. So, with that kind of a discount, should you do it? Well, we're going to talk about all of that here on this week's program of Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. One of Central Florida's longest running radio programs, coming to you on a host of stations throughout the Central Florida region. Also happen to be one of the top 25 financial planning podcasts out there on the World Wide Web. So make sure you take an opportunity to subscribe to us on your favorite podcast platform, or you can go to our YouTube channel, which can be found simply by looking for Nelson Financial Planning. If you have any trouble finding us on any of those mediums, well, just go to our website, also known as nelsonfinancialplanning.com. And from there, you'll see a bunch of icons. Click on the one that looks most familiar. It will automatically bring you to our channel on that platform. Once you're there, make sure you hit the subscribe button. That way, you don't have to kind of do that process again. My name, of course, is Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we got a team of great folks who also happen to be certified financial fiduciaries as well, who stand ready, willing, and able to help you improve your life with a successful and cost-effective plan this very week. So give them a call, schedule that absolutely free conversation. So before we get to all of that, a couple of things that we wanted to kind of talk a little bit about here in the opening segment of the program. If you're a regular listener to the show, you certainly have heard us talk about this many times before, but it continues to bear repeating because we continue to see people getting shortchanged. Please take a moment and check the rate that you are getting on your cash at your bank. We continue to see folks earning pennies when they could be earning dollars, particularly with cash. And folks, as we've said it before, this is a very unique opportunity. You know, we've been in this business for 25 years now, and we've only seen cash rates this good once in that 25-year period of time. So this would be the second time. So these opportunities don't come around very often, particularly for you to take that extra cash, that savings, and ultimately make a little bit of interest on it. Probably won't stay here for long because once the Fed starts cutting rates, then obviously those rates will start to drift downwards as well. But as long as it is here, certainly important to sort of take advantage of that opportunity. And certainly we suspect for most of the rest of this year, the Fed seems to be sort of on the sidelines. And so that means that those rates, particularly on money market rates, things like that, will continue to stay relatively strong. But I'll tell you, these banks, my goodness, they are not giving out higher interest rates for free by any stretch of the imagination. And unfortunately, what that means is that you, the consumer, is losing money in that equation. You've got to check it out. You've got to ask for it. Please make sure that you do that. Otherwise, you're leaving money on the table. That can really add up, right? If you got $50,000 in your emergency savings or cash reserves or something like that, and your bank is maybe paying you 0.25%, well, then that means that the $50,000 makes $125 in a year. Contrast that with $50,000 that's making maybe 5% in a money market. Well, that $50,000 is going to make $2,500. I don't know about you, but I think I could probably figure out something to do with that extra nearly $2,400 during the course of the year just on my cash savings, just on my emergency savings. That's certainly a big difference. So make sure you take the time, really check that out, because we continue to see where the banks are not giving away any interest for free. You've really got to be proactive and search it out. Number two is, if you are here in Florida and you have a business, then you know that this is sort of the annual report filing season here in Florida. Every year, that means that you must file your annual report for any business, any company, any limited liability company, any type of entity that's sort of formed under the laws of the state of Florida. And you have to do that. You have to file the annual report by May 1. Otherwise, it's a $400 fee on top of the normal fee. So plus, if you don't do the annual report and you kind of let it go, by the time it gets to the third or fourth quarter, well, then there's a process where it's automatically, your business could be automatically administratively dissolved by the state for failure to file the annual report. And basically what a dissolution means is, as you can imagine, when things dissolve, they go away. So that means your company would effectively go away if you're not taking the time to do this annual report filing. And folks, this is not anything new. This is not this Corporate Transparency Act stuff. No, it's got nothing to do with that. The annual report requirement in Florida has been around forever almost. And it's a form that is, it's not really kind of financial per se. It just confirms information like agent and address, and it's ultimately required to be updated each and every year, along with any changes in information in order to maintain your active status as a business or company in the state of Florida. So make sure that you are filing that annual report. If you're not and you miss the deadline, it's a pretty steep penalty to do that. Of course, with anything, right, that you're filing with the state, it usually generates revenue. So, of course, with the annual report, if you file it late, there's an extra $400 on top. Even if you file it on time, there's still a cost. If you're a for-profit corporation, it's $150. If you're a non-profit corporation, it's $61.25. If you're an LLC, you get a little bit of a discount off the for-profit rate, $138.75 to do that. Obviously, you know, it's super easy to do. It really is just kind of basic information: name, address, phone number, contact information, things like that. Go online to Sunbiz. That's the place where here in the state of Florida, that's sort of where the Division of Corporations operates from. Sunbiz, S-U-N-B-I-Z, and easy enough of a form, easy enough of a form to do it. And we would encourage you, obviously, to do it yourself, because if you don't, or if you're a little delayed on filing the report, your mailbox is going to start to get flooded, much like mine has started to get flooded, because there was one entity that we typically do this stuff in January just to get it done out of the way, but there was one that I sort of forgot to do. And so then you start to get letters like these, which we're hanging up for our YouTube audience, that say, hey, you know what? You didn't do your annual report, but we're happy to do it for you, except we're going to charge you like $100 to do it. Except it really doesn't take a whole lot of time. So maybe avoid these solicitation letters unless you like spending $100 for really is what might be 5 minutes worth of effort kind of thing. So anyway, it is in fact annual report season for businesses here in Florida. Make sure you get that done before May 1. Otherwise, you're going to have to throw an extra $400 on it and probably don't want to do that. Anyway, we're going to take a break and continue after these messages here on Dollars and Cents with Joel Garris of Nelson Financial Planning. So we got multiple hotspots, I guess, as you look around the globe these days, whether it's in the Middle East, Ukraine, China, We've got a contentious presidential election coming up upon all of us. That is, after this week's Super Tuesday votes pretty much set to be a repeat of what we previously saw. So, when you think of all of that, it's easy to be concerned. It's easy to be pessimistic. And let's not forget about the impact that happens when you walk down the grocery store aisles and realize that everything costs a whole lot more expensive than it used to. And so I think all of that is contributing to sort of this feeling of pessimism, if you will, out there. And you may be sort of wondering a couple of things, right? I mean, how is it that the market still, there's been some exceptions here just this past week. I think it was Tuesday where the negative reaction in the market. But beside that, the market has really been sort of on a pretty good trend of late. And so you may be wondering, well, how is the market still performing against this kind of a backdrop that's out there? And second, and this sort of ties into it and maybe helps to explain it, are there any reasons to sort of be confident, if you will, or hopeful about the future, particularly against the backdrop that dominates? And so we've got a few things that we thought we would share with you to try and answer those questions here in this segment of Dollars and Cents. So welcome on into the program here on Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. One of Central Florida's longest running radio programs, also a top 25 financial planning podcast as well. Make sure you subscribe to us on your favorite platform. Any trouble finding us, go to our own website at nelsonfinancialplanning.com. Look for those icons. They'll get you connected directly over to our channels on all those platforms. My name, of course, is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we got a team of certified financial fiduciaries who stand ready this week to help you improve your life with a successful and cost-effective financial plan. So how is the market still performing okay or decent, if you will? And I think, once again, we've got sort of a little bit of a tale of two cities going on out there, right? So the reality is that a large portion of America is still struggling and struggles against the cumulative impact that's probably about 20, maybe even 25% of inflation over the course of the past 3 years. Folks, that's a real impact, right? And even though inflation may be down to 3% or so now, that doesn't reverse the impact of that higher inflation over the course of the prior 3 years that cumulatively contributes to about a 20% increase over just that short period of time. And so the real impact, you don't need me to tell you this. If you've been to a grocery store, you see it predominantly at the grocery store. And therein, I guess, lies the direct impact on disposable income, right? The majority of America doesn't necessarily have a whole lot of disposable income. We see those statistics all the time in terms of average savings balances and, the amount of emergency savings that people have, the amount of money that they've saved for retirement. I mean, folks, these are real statistics. They're not just kind of arbitrary statistics. They reflect a picture of America that's certainly a large portion of the population that when you raise things by 20% at the grocery store, then there's a material impact on your ability to buy those things, which then ultimately impacts your mood, increases your pessimism, as you might well expect. And so I guess the flip side of that is that there's certainly a portion of the population that isn't really inflation sensitive. Maybe they'll complain about the price of a McMuffin or those kinds of things, but at the end of the day, they still are going to buy it, and it's not really going to have a huge impact. But that portion that is sort of less inflation sensitive usually is the portion that also contributes the vast majority of consumer spending. Fortunately, that's just kind of how it all plays out. And certainly that consumer spending is helping to keep the economic numbers decently enough. So I guess I would say part of it is that there's really this sort of tale of two cities, if you will, at operation out there. Some people would say that's the wealth divide, in living time. And that's probably a decent enough way to describe it. But beyond that, we think that there are some kind of real reasons to be confident or to be hopeful and optimistic about the future, because it always goes back to sort of the raw data, right? So the raw economic data is probably stronger than what you and I or the average person might necessarily realize at this point. I mean, gross domestic product, which is obviously the measure of the economy, for the fourth quarter came in at 3.3%. Nothing wrong with that. That's pretty good. Wage growth year over year at the start of the year was about 4.5%. Again, okay, well, that's running a little bit better than current inflation, at least. Again, you still get that cumulative impact. That's really the tough problem, is that cumulative impact of inflation, particularly over that short of a period of time. Mortgage rates have gotten a little bit better. You see them kind of more down 6.5 versus kind of trickling up to 8 where they were a few months back. Also a bunch of government spending coming online, and we can sort of debate that as to whether that's good or bad, because they're probably borrowing money to spend, but hey. Projected to be at about $1.4 trillion. A lot of that's the Inflation Reduction Act, a lot of that's this energy stuff, the infrastructure stuff, all of that continues to come online for capital expenditure projects. And when you spend money on capital expenditure projects, so think bridges and railways and manufacturing plants and things like that, there's a multiplier effect on that, right? Because you need people with skills in order to build a manufacturing plant or to build a highway. And so then when you're spending money on those, then it actually helps increase wages sort of across the board. And then, of course, lastly, Fed rates relatively stable, right? No sign that they're going to start raising rates anytime soon. The bias is still towards cutting rates. So you look at that, and that's not a bad economic backdrop, which I think goes a long ways to sort of helping to explain sort of where we are. And then another thing that I think hits the list of reasons to kind of be a little bit more hopeful in terms of the future, you can't ignore this AI, artificial intelligence kind of thing. And this has been happening along the way for a while, and it just seems like it's really kind of hit the accelerated path, sort of like internet on steroids. Doesn't appear that it's going to be kind of another Y2K. If you remember Y2K, there was a big build-up, big brouhaha over what needed to be done, and then the year changed and the calendar changed, and it wasn't really all that big of a deal. In contrast, the reality is that with AI, there appears to be a real potential for productivity gains, right? And so productivity gains that are expected to help companies is a good way to sort of offset the impact of inflation, because you can get more out of people, then you don't have to worry about, I've got higher costs in terms of wages or employees, because if I can get more out of my current employees, then that really does help to offset. Higher productivity helps to offset in inflation. So with AI, the power to automate tasks, to streamline workflow, certainly accelerating technological advances, healthcare advances, those kinds of things. So the mix of that, or the contribution impact of AI on the economy, particularly kind of where we see it right now, is truly enormous. And so those are some of kind of the initial things that we wanted to share with you. When we return after the break, we're going to share a few other things that are kind of on our minds to sort of help answer the question of, is there really reason for optimism going forward in the markets against the litany of headlines and backdrop that we see out there in those headline events? So we're going to continue this topic when we return here on Dollars and Cents with Joel Garris of Nelson Financial Planning. In the program this week, we're sort of talking about some of the reasons to be a little optimistic about what the future may hold for the markets and the economy. And it's sort of an interesting sort of juxtaposition versus what seems to be some level of pessimism out there, particularly if you think about some of the headline events that are happening, all these hotspots all around the world. It's a presidential election year, in case you forgot. That also is weighing on people's minds. And so, you have all these events that are happening, and then, should you darken the door of a grocery store, well, then you see the cumulative impact of inflation that has happened over the course of the past few years. And certainly there's some reasons why that pessimism might be founded. But we thought that we would take a moment and sort of explain, because the market's not really reflecting that pessimism now, right? Market continues to kind of move upward. End of the year quite strong. Last year was a good year for the market. Start to the year, market continues sort of its upward increase. So what's causing all of that? What's sort of the factors behind that? And before the break, we kind of got into a couple of them. One is just the raw economic data. GDP still at 3.3% for the fourth quarter of last year. Wage growth in January about 4.5% over prior year. Big expenditures expected on infrastructure, things like that. So the pure data would say, oh, well, maybe there's reasons to be hopeful. And then if you layer on that all this AI, artificial intelligence conversation, and certainly, and we've certainly joked about it on the program here, you've got kind of the Terminator path that can go. The reality is that a lot of companies are viewing it as a way to increase productivity. And if you increase productivity, so stop and think about what that means. If I'm increasing productivity among my current employees, right, then I don't have to hire additional employees, because I can get my current level and numbers of employees to do more by being more productive. That seems to be kind of the key concept behind this artificial intelligence conversation. Is it going to be able to automate tasks, streamline workflows, things like that? So those are a couple of the things that are happening out there that we think, really should contribute to some continued optimism, or perhaps give us some hope for optimism for the economy and the markets ahead. The kind of the third thing on this list that we're kind of talking a little bit about today is that the market breadth, if you will, width, if you will, is expanding. And certainly this goes to the concept is that a lot of the market growth of late has been contributed to a very small handful of companies. That handful of companies consists predominantly of AI-type companies. You've heard of them perhaps referred to in the mainstream media as the Magnificent Seven. It's Microsoft, it's Amazon, it's NVIDIA, it's that collection of companies that over the past couple of years or so have really dominated and contributed the lion's share of the improvement in the markets that we have seen. But what is happening now is the other 493 companies that make up the S&P 500 index, for example, are starting to show some life. Because if you look at the S&P 500, which obviously is 500 different companies, you'll find that that Magnificent Seven, those 7 out of the 500, really have contributed that lion's share of performance. Meanwhile, the other 493, particularly over the past couple of years, have been relatively flat. And what's starting to happen is those other 493 are starting to kind of carry their weight, starting to have, broader earnings, things like that are contributing to the overall market. So as the market starts to get a little bit broader and less dependent upon that small handful of companies to drive it, then you start to see stronger results across different industries and across different companies. And to think more on that, the reality is that another factor that's sort of at play here is this notion that it is a global economy, right? And we hear a lot about that. But what's also happening is that there are other leaders stepping up or stepping in to the global economy. The clear statistic of that is that, and maybe you saw this, maybe you didn't, but Mexico this year surpassed China as our largest trading partner, right? Now, stop and think about the logistics there. It's just south of us. It doesn't have to go across the big ocean, things like that. So getting a little bit more efficiency in terms of that trade partner relationship, where Mexico now surpasses China as our largest trade partner. Interestingly, if you kind of look around Asia as a whole, and look at those other sort of emerging markets, or certainly not third world markets, but places like Singapore or Vietnam or Thailand or Indonesia, that group of countries recently surpassed about 60% of the trade level that is with China. So some of that obviously related to the trade disputes and whatnot that have been happening over the past few years between the U.S. and China that got accelerated as a result of COVID and the supply chain breakdowns and things like that. But as we think about that global economy, as you have more players at the table, then it does help improve certain efficiencies and certain costs. So that's kind of the other factor that's at play out there. And then I think lastly, some of these ongoing healthcare breakthroughs have really been incredible, not just for humankind, but also for some of the fundamentals in healthcare as well. You certainly kind of see the impact of AI in that area as well. If you're a client of Nelson Financial Planning and come to our kind of quarterly educational events, you know that our featured speaker, the past two sessions, so the one we had in January and the one we had back in November, said very candidly, and both of them, different people, different organizations, expect a cure for cancer sometime in the next 10 years. So, kind of interesting to see all of that happen. We got another one of those coming up actually on March the 28th. So if you're a client, you'll get a reminder about that this week, along with the Zoom link to attend remotely. And then let's not forget about those obesity drugs along with the treatments for manage diabetes. The reality is that it underscores sort of these themes of maybe there are some reasons to be a little bit more optimistic out there than the general level of pessimism that exists. Of course, one of the impacts of all these healthcare improvements is that you're living longer, and that requires a different investment perspective than certainly what you have maybe followed in the past. Because if you're going to live longer, then your money needs to be positioned not just for pure income purposes, but obviously for some growth as well, especially with all those great medical science inventions that are going to extend your life expectancy. So certainly something to think about, and certainly some reasons for overall optimism across the board. We'll see how all these themes play out, obviously, as we go through the year 2024. Certainly a lot of headlines in front of us as well. So to change topics a little bit here and gear up for our last segment here on dollars and cents. Maybe you've heard these ads, maybe you've seen these ads online. But the next segment, we're going to talk a little bit about these prepaid plans, these college prepaid plans here in Florida. And the ads read that, hey, the prepaid plans are on sale. Big news. There's a price reduction, lowest prepaid prices in 10 years. In some cases, the cost of these prepaid plans has been lowered by up to 25%. So should you take advantage of that deal? We'll answer that question coming up next here on Dollars and Cents. This is your host, Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning. You're listening to Dollars and Cents. So maybe you've seen the big news, the price reduction for state of Florida prepaid college plans. The ads read, everything's on sale. It's the lowest prepaid prices in 10 years, lowered by up to 25% in some cases. So the question is, with that price reduction that we're seeing on Florida college prepaid plans, should you take advantage of the sale? Well, on this segment, we're going to explore the ways and the reasons why you might not want to take that deal. All coming up on this segment of Dollars and Cents, here where we make sense out of all of life's decisions involving your dollars. One of Central Florida's longest running radio programs. Also, a top 25 financial planning podcast on the big wide world web out there. My name, of course, is Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we got a team of great people who stand ready this week to talk about your options, whether they be about college saving or retirement or investing or taxes. All of that is fair game for conversation here at our office at Nelson Financial Planning. Interested in learning more, just go to our website, nelsonfinancialplanning.com, and check us out there. You'll see things like our investment philosophy, our approach, why we do things the way that we do. All of our conversations, of course, are absolutely free, so don't hesitate to schedule that free conversation once you're on the website at Nelson Financial Planning. So let's recap some of the fundamentals here when we talk about saving for college, right? Two sort of options. You've got the prepaid plan, and then you have like a savings plan. So the prepaid plan, you kind of lock in the tuition rates. That's the plus. It's effectively risk-free, right? If you buy like a 4-year university plan, well, then you're going to get the benefit of having 4 years of tuition covered by virtue of the prepaid plan. Unfortunately, if you don't go to college, then you just get your money back without really any interest. And ultimately, there's sort of a preference for in-state, right? Because if you go out of state, you just get sort of the equivalent value, and that might not be as clean a conversion, if you will. So those are sort of the quick pros and cons on the prepaid side. Savings plan, college savings plan, in contrast, is pure investment, right? So there's more risks there because however much you have for college is clearly a function of what you invested and how well that did over time. But the flexibility on those savings plans is really pretty broad, not necessarily a bias towards in-state. Use it pretty much anywhere, and use it for anything and everything, right? With the prepaid plan, you might buy the tuition, but the tuition doesn't cover the dorm, it doesn't cover the books. With a savings plan, you can use that money for whichever part that you want, as long as it's a valid college expense. In fact, we dedicated a whole chapter in our new book, Next Gen Dollars and Cents, to this topic and understanding your choices for college savings. So if you haven't gotten your copy of your Next Gen Dollars and Cents book, it is available on Amazon, or as we like to share with our listening audience, if you make an appointment with us for one of those free conversations, chances are we'll give you a free book when you come on in as well. So that's kind of the end around, if you will, to not have not give Amazon too much business, because heaven knows we all give Amazon a lot of business. Anyway, so we got a whole chapter in the book dedicated to your choices when it comes to paying and saving for college. But I wanted to give some very specific examples on even with this sort of sale on Florida college prepaid plans, why we're not really a big proponent of it. And so hopefully this example will help to give some perspective on it. You're going to have to stay with us kind of through the math and all that. But let's say you just had a kid. Or you just had your first grandkid or grandkid, or whatever, and they are a newborn. So if you go to the state Florida prepaid website, kind of look through it, figure out lump sum that is needed for a 4-year university plan. You'll see that the lump sum is $27,373.47 to be precise. Now you can pay that in a variety of ways. You can pay that over a 5-year period. You can pay that monthly. You can pay that in a ton of different ways. We just kind of looked at the lump sum number because that's kind of easiest to kind of work the math, if you will. So if you were to purchase a Florida prepaid plan today for a newborn with the special 25% off, biggest price reduction, lowest prices in 10 years, all this stuff that's all over the website, then you would need $27,000 and change. What also that same website says is that it estimates that the plan payout, or the value, if you will, of that $27,000 and change when that newborn goes off to college in 18 years is expected to be somewhere around $66,500 right there on the website. So by their own calculation, if you give them $27,000, they're going to give you back a benefit equal to $66,500. That sounds good until you actually start to run the numbers on it. So if I got 27 and the expected value is 66.5 in 18 years, that's sort of the future value of those dollars when today's newborn goes off to college in 18 years. So it sounds good, but if you take the same $27,373, that lump sum amount to buy the 4-year university, and just assume 8%. And look, that's like 80% of the historical long-term performance of 10%. So not over-assuming here by any stretch of the imagination, if you will, in terms of sort of tracking out over time, markets close to 10%. Okay, fine. Let's just assume 8%. At an 8% investment return rate, money's going to double in about 9 years. There's a rule of 72 that makes it easy. Take 72 divided by the rate of return, 8 equals 9. That tells you how long it's going to take money to double. If you're interested in more about that rule of 72, see the book, Next Gen Dollars and Cents, because we got some paragraphs in there about that. So if we take that and we run the numbers on the $27,373 that it takes to buy the lump sum 4-year university, tuition only, no books, no dorm, no nothing besides that. You know what that turns into? Run the number. Turns into about $108,000. That's more than $66,500. In fact, that's about 62% more than $66,500. So even if I'm way off on the assumption, maybe it's only 6%, maybe it's only 7%, you still wind up pretty far ahead versus what you would get. And the beauty of a college savings plan is that you can use that money for anything and everything college expense related, right? So that's not just the tuition, that's the dorm, that's the books, all of that. Hopefully y'all follow that math, clearly. The younger the beneficiary is, I think the answer is pretty crystal clear, right? Because they've got a long time frame for that money to grow and double. And ultimately, the decision then, particularly for that newborn, just makes a lot of sense to kind of pursue the savings and the investment orientation of a 529. Now, next example that we'll kind of put in here right at the end. Let's say they're in 8th grade and you haven't done anything yet. Right? Entering high school in the fall, the 4-year plan for them is $25,792. The expected payout, $34,000. This one's a little bit closer because it's a shorter time frame, right? And so there's a higher likelihood that could be negatively impacted by the market, right? The shorter the time frame, the more you have to worry about underlying volatility. Same assumption of the 8% gets you roughly around that same amount, if you will, in terms of the expected payoff. So not that materially different, but remember the flexibility. There's a lot of flexibility with these savings plans, and that's significant and certainly creates a real advantage. So hope you followed that example and an analysis. Yet again, the importance of running the numbers, performing the analysis on any financial decision. On this one, don't buy the hype of lower prices. It is still not a particularly good deal for your kids' college savings strategy, especially if they are younger. Those are the kinds of things that we are here to talk about in the office at any time. So don't hesitate to give us a call at 407-629-6477 or visit our website, nelsonfinancialplanning.com, to schedule that free conversation at any time. Have a great rest of your day.